XRP has been trading sideways for 107 days. The price looks boring, but out of 193 total trading days since spot XRP ETFs launched in the United States, only 13 were outflow days. 90% of days, institutional money was moving in. The price is quiet, the data is not. Before we go any further, did you already know that institutional money was flowing into XRP 90% of all trading days? Drop a yes or no in the comments right now. This is not financial advice. This content is for educational and formational purposes only. Always do your own research before making any financial decisions. If you find this kind of institutional data analysis useful, a quick like helps this channel reach more people who need to see it. Now let me walk you through exactly what happened and what it means for the thesis you have been holding. A spot exchange-traded fund, commonly called a spot ETF, is a regulated financial product that allows institutional investors to gain direct exposure to an asset's actual price without holding that asset themselves. When pension funds, wealth management platforms, and large asset managers want a position in XRP, they enter through a spot XRPF. It is the regulated, institutionally accessible front door to this asset class. Retail investors typically find their way in through exchanges and consumer apps. Institutional investors use ETF infrastructure, and that distinction matters because the money moving through ETFs is a fundamentally different class of capital with a different investment time horizon than retail trading activity. Since spot XRP ETFs launched in the United States, there have been 193 total trading days on record. Out of those 193 days, only 13 registered net outflows, sessions where more money left the funds than entered. The remaining 180 days were net inflow days. That is 90%. Total net inflows across all 7 US spot XRPs have accumulated to $1.441 billion since launch. In the most recent 15-day window alone, $116.48 million flowed in with 0 net outflow days across that entire stretch. Bitwise, one of the leading ETF issuers in this space, recorded over $10.9 million in single-day volume, and 94 million XRP tokens are now locked inside just these 7 US-based products. Globally, the figure rises to over 1.3 billion XRP locked in spot ETF structures around the world. Large institutional capital has been moving into XRP on 90% of all trading days for more than 6 months. And yet the price has spent 107 consecutive days, going essentially nowhere, trading in a range between $120 and $1.50. Two interpretations exist in the analysis community for why this is happening. Both read the same data. Both reach entirely different conclusions. The first focuses on the Binance order book. Binance is one of the world's largest cryptocurrency trading platforms. The 30-day liquidity index on Binance recently crashed to near zero. Liquidity in plain terms is the density of buyers and sellers lined up at various price levels. It measures how thick the market is at any given point. When that density drops towards zero, the order book becomes thin and exposed. A single large purchase, millions of dollars entering the market in a short window, can move the price significantly when there is very little on the other side to absorb it. This is the foundation of what some analysts drawing on analysis associated with Shane Ellis and others who track order book depth describe as a thin order book setup. Low liquidity combined with incoming demand creates conditions for sharp, fast price movement in whichever direction the first major order pushes. The cumulative volume delta on Binance, which tracks the The running balance between aggressive buying and aggressive selling recently recorded its deepest negative reading in months, meaning sellers have held control of the tape. But analysts who view this as a setup rather than a warning point to the behavior of the spot price. XRP has been holding at $1.34 even as futures traders are positioned heavily on the short side, meaning a large number of market participants are betting the price will fall when spot holds while short interest accumulates. One reading is that the short side has run out of room to push lower and is now vulnerable to a sharp reversal when those positions unwind. One analyst described the current configuration directly. This is the calm before the storm. The second interpretation looks at that same low liquidity and arrives at the opposite conclusion. It notes that the last time XRP exchange liquidity dropped to these levels was during the XRP bear market of 2020. In that period, holders were not moving their tokens off exchanges in anticipation of an imminent move. They were moving to personal storage wallets because there was no compelling reason to trade at all. Capital was rotating toward safer assets during a period of macroeconomic uncertainty. And one analyst adds a detail that matters. Even after the liquidity index started recovering in 2020, XRP still moved lower before its eventual run. In this reading, low exchange liquidity describes disengagement, not compression. There is one data point that belongs in this conversation, regardless of which interpretation you find more credible. Google's search volume for how to purchase cryptocurrency exploded in May. This is a retail signal. Institutional investors do not use general search engines to figure out how to enter an asset class. They have over-the-counter desks, prime brokerage relationships, and direct infrastructure access. When Google search interest spikes for crypto buying, it reflects ordinary individuals re-engaging with the market or new participants arriving for the first time. That incoming retail attention represents a potential wave of capital that operates entirely separately from institutional ETF flows or exchange order book dynamics. And right now, both appear to be building in the same general direction. The XRP crowdfund sentiment data recently reached its highest level in 3 weeks, showing a ratio of 1.1 bullish to 1.0 bearish. That barely positive reading describes a community that is not confident, not pessimistic, but genuinely uncertain. Near-neutral sentiment periods have historically marked the windows where conviction investors operate with the least competition. The multi-year technical support line for XRP, tracked since 2018 and tested as a meaningful price floor multiple times across that period, sits in the 70 to 90 range. Analysts Ali Chart and Chartner have both identified this zone as the level the long-term chart suggests XRP may revisit before any significant upward leg begins. Ali Chart pointed to 73 cents specifically as a mid-range within that zone. Chartner has described the 70 to 90 area as a historical foundational target and believes the path toward $8 and beyond only opens after that support zone is either tested or confirmed. He has been direct about the fact that this analysis has cost him followers among those who want only bullish coverage. He publishes it because the long-term chart data supports it. Both sides of this debate have credible historical foundations, but neither is fully accounting for something happening outside the price chart. So, the question worth asking is what exactly Ripple has been building and whether it matters more than the current short-term argument over price direction. Ripple recently filed for 2 new trademarks, extending legal protection to their Tracillion and World Mark branding across a range of services. Trademark filings do not generate headlines in communities focused on daily price movements. But reading what Ripple specifically chose to protect tells a precise story about where this company believes it is positioned. The first layer of protected services covers downloadable software for treasury operations, payment services, the transfer of funds, digital asset management, cash management, investment management, risk management, and bank reconciliation. These are the standard tools of institutional money management at scale. The second layer goes further: investment banking services, investment advisory services, financial asset management, hedge fund operation and management, credit intermediation services, lending services, execution services, and repurchase trade execution. These are not payment technology services. They are the core business lines of established financial institutions. Securities brokerage services, prime brokerage services, clearinghouse services, clearing as intermediary for foreign exchange, futures, equity swaps, repurchase agreements, United States Treasuries, fixed income securities, and derivative products, financing services, securities lending, margin lending, post-trade settlement, and brokerage covering digital assets, fixed income, foreign exchange, precious metals, securities, futures and commodities, electronic data storage services, financial information services. Two terms in that list are worth explaining. Prime brokerage is the set of services that large hedge funds and institutional traders depend on for day-to-day operations. Securities lending, leverage financing, custody, and back-office clearing functions. It is one of the highest value service lines in global banking. Post-trade settlement is the back-end process by which a transaction is confirmed, assets are transferred between parties, and accounts are formally reconciled after a trade takes place. Every transaction in every financial market on earth requires it before it is legally complete. When you read the full list of what Ripple has now legally protected, you're reading a description of a company that has positioned itself to operate across the entire stack of what global financial markets require. From the initial execution of a transaction through its clearing, settlement, and final account reconciliation. 3 decades of building savings carefully teaches something no short-term trader learns. The real advantage in any structural market shift goes to the person who identified the infrastructure being built before most of the capital understood what it was for. Not because they predicted a specific price on a specific date, but because they recognized the shape of what was forming. The investor who understood in the early 1990s that the internet was going to require routing infrastructure, or who understood that any new payment system would need settlement rails, did not need a price target. They needed to understand the structure. Ripple and Boston Consulting Group, one of the world's most respected management consulting firms, published a joint report projecting that the global market for tokenized real-world assets will reach $9.44 trillion by 2030 and $18.9 trillion by 2033. Tokenized real-world assets are physical or financial assets, government bonds, commercial real estate, commodity positions, private equity, represented as digital tokens on a blockchain with ownership recorded and transactions settled on-chain. It is already active across multiple platforms. Today, it is growing. The XRP ledger currently holds approximately $4.7 billion in tokenized real-world assets. Ethereum, the largest competing platform in this space, holds approximately $18 billion. The XRP ledger needs to close roughly $14 billion to reach Ethereum's current level. But Ethereum's current level is not the target this report describes. The projected market is $18.9 trillion. The XRP ledger holds $4.7 billion of it today. The infrastructure to pursue a much larger share of that market is being built, tested, and legally protected. Right now, Grayscale, one of the most established institutional digital asset management firms in the United States, currently holds over $65 million in assets under management in XRP. The significance of that number is not its current size. It is the timing. Grayscale structures institutional products before the large capital allocations behind them arrive. When they build around an asset, they are building for clients whose capital is orders of magnitude larger than the product's initial size. Their existing product structure around XRP before the broader market develops reflects exactly the kind of pre-positioning that has preceded broader institutional adoption in other asset classes they have covered. Korean analyst 9X has published an analysis identifying a $5 base case target for XRP if price moves toward the upper boundary of its middle channel, and a $20 scenario dependent on a break above the upper edge of a decade-long channel. Similar in structure to the 2018 breakout. These are analyst projections, not guaranteed outcomes, but they illustrate that the structural conversations at the institutional analysis level are not about whether XRP goes to $70 or $1.50. They are about multiples from current levels. One question remains open after all of this data. The one piece nobody in daily price commentary is asking. Ripple has 10 years of direct client relationships with banks, financial institutions, and cross-border payment partners around the world. Every service now protected in those trademark filings is a service Ripple can now offer to each of those existing clients. Before these filings, if a Ripple client asked about prime brokerage or clearinghouse operations, the answer was that Ripple did not provide them. That answer has changed. The list of institutions that will now receive that expanded pitch is private. It is not published anywhere, and it may be the single most important data point in this entire story. Pull back now and look at the complete picture of what the data covered today actually describes. 7-spot XRP ETFs have been operating in the United States for 193 trading days. Net inflows occurred on 180 of those days, 90%. Total institutional inflows reached $1.41 billion since launch. In the last 15 days, $116.48 million moved in with zero outflow days. 94 million XRP tokens are locked in those US-based products. Globally, over 1.3 billion XRP is held in spot ETF structures. The price has spent 107 days between $120 and $1.50. Exchange liquidity on Binance is near zero. Net taker volume registered its deepest negative reading in months. Technical analysts are split. A credible case exists for a retest of the 70 to 90 cent support zone, and a credible case exists for a break higher. The short-term picture is genuinely unresolved. Those two descriptions appear to tell different stories. They do not. The ETF flow data and the price data reflect the same period of time. Together, they show that large institutional capital has been entering XRP steadily and consistently, while the price held in a tight range. A pattern not unusual during periods where buyers and sellers match each other at approximately the same level until one side depletes. Now add Ripple's trademark filings across the full stack of global financial services. The BCG and Ripple joint projection of $18.9 trillion in tokenized real-world assets by 2033. The XRP ledger's current $4.7 billion in that market. Google search data showing retail interest surging in May. Grayscale's existing product structure around XRP. 9x's structural analysis pointing toward $5 and $20 scenarios. The July 2025 POSC narrative has faded, which means the current institutional inflow data is not being driven by a regulatory storyline. It is being driven by structural positioning that is a different and more durable foundation than narrative momentum. The pattern across all of this is a convergence of institutional positioning, legal infrastructure protection, independent third-party market projections, and growing retail attention, all arriving in the same window, while the surface story is a flat price line that most casual observers have stopped watching. For someone protecting savings built carefully over decades, the short-term debate over whether XRP moves to 70 cents or breaks higher in the next few weeks is a smaller conversation, sitting inside a much larger one. The larger conversation is about whether the infrastructure for something structurally significant in global finance is being assembled right now, during a period when most people are not paying attention. The ETF inflows say the answer is yes. The trademark filings say yes. The BCG report says yes. Grayscale's positioning says yes. The convergence of all four of those signals in the same window during a period of boring price action describes exactly the kind of setup that patient investors who have built something worth protecting tend to notice before the crowd does. Most people watching this week's price chart see a flat line. The data shows something different from a flat line. After everything we covered today, what do you think is the most overlooked part of this story? The ETF inflow data, the trademark filings, the BCG projection, or the private client list that nobody can see? Drop your answer in the comments. I read every single one. If this video gave you a clearer picture of what is actually happening, go ahead and like it. It helps this channel reach more people who need to see this, and subscribe so you do not miss the next one. Share this with someone in your circle who is only following domestic crypto news and has no idea what is happening globally. Stay informed, stay positioned. I will see you in the next.